Okay, hello. You're going to, so today, first thing we're going to do is go over the journal entries that I emailed out last week. Any questions you guys have on, we'll just go through and chunk them in. And then we're going to do the adjusting entries, some more adjusting entries. And then we're also going to do closing entries. And that'll be it. So let me do something here. Okay, so we're gonna start out with this today. This shouldn't take too long. This will take a little bit longer. Closing entries are fast. This won't take very long. I'm going to email your chapter 2 exams will be emailed out tomorrow, and I was going to do it tonight. I actually have a little bit of an emergency that I have a dog that we had surgery on for her legs, and now there's a bone sticking out. It broke through the skin. There's a bone sticking out of her leg, which I'm horrified by it. The dog doesn't seem to mind, but anyway, so I'm thinking we probably have to take her in for some kind of an emergency something. But anyway, so I probably won't get it out tonight. It'll probably be more like tomorrow I get the exam. So, but if I can get it out tonight, I will. But anyway, so the exams are very similar to what we used to do with class. Same format. You'll be able to do it in Excel, in Word, or in like the PDF files. One thing I do want to point out, just and I included, I think it's actually, it may even be in the, I may even have it in the Blackboard. It should, if I don't. My Blackboard here for a second. Yeah, if you look on Blackboard, right in the announcements, if you want to use Excel, if you don't have it on your computer, you want to use it, you can actually do it right from here. You can do it through your email also, but it's also included on the in the announcements that put it in there. So if you just click on that, I don't know if I showed you guys this or not, probably did. But anyway, so you can click on that and then you can upload the file into it. Hey, try that again. And you can open the file. You know, find browse. Open files from this device, so stop. Anyway, that is available if you want to use it. They also have Word in it. They actually have quite a bit of stuff in it. Okay, so let's go to sold inventory for cash for 3,500, and the cost of the inventory was 2,000. Anyone have the journal entry for that one? You want to list it off? You don't think they have it?
For the first one,
Yeah.
was it cash debited for 3,500?
Yep.
Then you credit sales revenue for 3,500?
Yep. I'm gonna do something here. I got all these bolded, but I obviously don't. Okay. And you also have to do what? Take out.
Cost of goods sold for 2,000.
Yep. And this is similar to an expense. It's actually not in cash, but it's in goods. And we take that out of
On inventory.
Yep. And you can look over here, if you want, if you don't know the debit and credit, you look over here, inventory, it's gonna decrease. So we didn't actually give them cash, but we gave them, inventory, what the inventory cost is. Pretty good. Purchase equipment on account from Strong Company. The full amount is due in 15 days.
You would debit equipment for 5,500.
Yep.
And then credit accounts payable for 5,500.
Yeah, we haven't paid them yet, but we will. So assets are going up, liabilities are going up. Received an invoice, $150 invoice from a local newspaper requesting payment for an advertising that will take place on January 2nd. Oh, okay. So we already, I get it. The invoice came, apparently that we didn't make the journal entry at that time. Quinto is right there, right? Okay, so what would the journal entry for that be?
Advertising expense, debit, and credit.
Oops. Accounts payable. They received it. They didn't say they didn't pay it yet. By the way, if you're doing auditing, one of the things you kind of check for is this is an area that they could really you could have a problem with in that they get a bill and they don't put it into the system. For instance, let's say they want to make themselves look more profitable. They get this advertising expense bill, they don't put it in the system, they throw it in the drawer. They're gonna pay it, but they just don't want to have it on the books at year end. So how do you find that? How do you find if they have, if they're doing this, if they're having, if they got a bill, but they're not paying it, so they don't have it on the books. Because notice no cash has gone out. Actually, I'll tell you how you find it. How you find it is you look at the cash disbursements for the following month. Because even if they don't have it in the books, they generally have to pay it. So you look at the following month and see if there's anything they pay in the following month probably should have been on the books at the end of the year. So if they are, they get a bill in the mail, we don't put this in because it'll make us look bad. They throw it in the drawer. The way you find that is through subsequent payments with the following month. Things that they pay in the following month usually are things that should have been on the books in December. Okay. Sold inventory on account. Just do them. Now we sold it for cash. Okay, sold inventory on account. What's the journal entry going to be?
It'll be accounts receivable, debit for 5,000. Right below that, you're gonna credit sales revenue 5,000.
Yep. Very good. And again, some people may question, well, why do we put that? I mean, we haven't got the cash yet. Why do we count that as a sale? We do it because it's been earned. And one of the things about recognizing revenue is you recognize revenue. Oops. Yeah. So revenue is recognized when earned. So even though we don't have the cash, if we've earned it, in other words, they've taken the merchandise, they owe it now. So now we're recognize revenue. Okay, now we have to take it out of what? Inventory. So we have what? Cost of goods sold. We do see this. That's gonna be the same as up here. Hey, I could be lazy and copy that. 2,800. So our cost of goods sold, again, this is kind of like an expense. But we're not gonna pay it in cash. We pay it in goods. You know, instead of paying an asset of cash, we pay them, we are giving them an asset of goods, and it's leaving the place, so we have to take it off our books. We no longer have it. All right, purchase inventory on account 9,500. Anyone? Is there inventory going up or down? Do we have more or less?
It's going up.
You got more. Yep. So our inventory is going up. You'll have increase with a debit. Oops. It's going up. I'm in the wrong place. I'm sorry. And an account would be accounts receivable or accounts payable?
Payable.
Payable. We owe them money. They don't owe us money. Purchased equipment for cash. Okay, so this one bought it on account. Wait, is that the same one? Yeah, on the 15th. There was a 15th. No, this is a separate transaction. Okay, so this will be equipment. 800. And we paid them cash. This is just swapping one asset for another. Equipment's going up. Debit, and our cash is going down with it. Do you guys want me to put the plus and minuses, the asset plus and minuses? I've had people say, well, you know what the hard part is, the plus and minus. I get the journal entry, but maybe I should put those in. Okay, paid the entire amount due to Strong Company. I imagine that's the one from the second. Yep. Okay, so we got to pay off this accounts payable for 5,500. So what's the journal entry? This one that gets missed actually quite a bit. Oops, never mind. Okay. We have a stab at it. What a terrible expression. You would have an idea what we should do with that one?
Accounts payable debited 5,500 and then cash credited 5,500.
Yeah. And they're both going down. We no longer owe them. I'll put this one in. They're both being reduced by 5,500. So we have less cash, but we also have less liabilities. Receive 4,000 from customers on account. Imagine that's from, I'm gonna assume that's from up here. Here. Probably on the 8th. So we received 4,000. Okay, so what's gonna be that entry?
Cash gets debited for 4,000.
Yep. Cash is going up. And accounts receivable, oops, that's not how you spell it, receivable is going down this. I said going down. This one actually won't make any difference in your total assets, because one asset's going up, one asset's going down. However, you would rather, whoa, don't do that. You would rather have cash, obviously, than the accounts receivable, so you are happy about it, but your overall assets don't change. Pay $800 to the owner of the building for January's rent. I'm gonna come over here for a second. Even though we do have, what happens if your expenses decrease? The fact of the matter is, it's a very rare occurrence. How often do you have your landlord give you money? Probably not too often. So for these, while theoretically they could happen, they're very rare. So almost all of these are going to be with the increase. So anytime you have an expense, it's going to be a debit. Expenses are debits. Uh-oh. Says my connection's unstable. Last time this happened, I got kicked out. Wonder why it's stable. I'll get this one in before I do anything. Okay, so rent expense. My audience. I apologize, guys. This I might switch over to recording. Good. Okay, I might switch over to not today, I'd say, but I have my own Zoom account that I use instead of the schools. I had this happen last week in a different class where it got unstable. I think it's from going through the school's Zoom account. This happened years ago, and so that's why I got my own account, because it kept losing. It actually kept losing the recording, and I lost one last week, which hasn't happened in years. But anyway, it might start if it is unstable. It might go back to using my account, but I'll worry about that. Hopefully, you guys can. Okay. Rent expense. We I assume we paid cash for this. Yeah. Sure, we do one more thing. I just want to check and make sure it's recording. It's still recording. Okay. Last time it stopped recording, which was bad. Okay. Paid employees $3,000. What's the journal entry for that one?
Salary expense debited 3,000, cash credit 3,000.
And just get used to that salaries, or excuse me, expenses are always debits. And knowing that the debits have to equal the credits, whatever's on the other side, has to be the credit. So it makes the journal entries a lot quicker, a lot easier. Just to be any expense is a debit. And it literally is that, usage of money. What do you use money for? Well, you can buy assets, equipment, all that kind of stuff, or you can pay bills, so that's why they increase with debits. And on the other side, how do you get money in? You can borrow the money, the owner can have it, or you can sell something. So you get money in. So this is a resource for cash, and this is a use of it. That's why they're different. That's why they always equal. Okay. Pay a cash dividend to shareholders. Dividends are always debits. Similar to expense. That's what you're using money for. So dividends are always, I don't like the way the book shows it, and I don't like the way most books show it. So dividends. Our cash is going down by 1,000. But I'll tell you what I don't like about it. Maybe that this is basically an equity account. If you look at the equity account, it says, okay, it increases with credit. Well, why does this one, it's an equity account, increase with a debit? The account itself is just there to keep track of the numbers, but it's dividends actually reduce your equity. Now, it would still be a debit if you thought about it that way. That it's reducing your equity, it would be a debit, kind of like here. But they almost always show this as being increasing with a debit. So I will leave it because it is a use of cash. And you also notice something is different about this equity account compared to this one. This one is a permanent one. This one is what they call a nominal. Nominal accounts are accounts that don't last. Oh, here's the I think we got them already. Yeah. Okay. So that one can be turned in. And do you have any questions on that one? All right, good. Yeah, so those are the okay. Adjusting entries.
This is a new one we're starting now, right?
Yeah, this is problem 2-3.
Got it.
I should ask, are there any questions on 2-2, the journal entry ones? Hey, look, and now my screen's wider again. Any questions on 2-2? Okay. All right, let's go to adjusting entries. I might put a few notes on adjusting entries here. You don't have to put this in. It's good. Okay. Yeah. Adjusting entries always have either a revenue or an expense in it. Adjusting entries are not triggered by an event. Talk about that in a second. I'll leave it there. Okay, so here's what I'm talking about when, okay, so they either have a revenue or an expense. I can't think of anyone that would have both. There might be one, but they either have a revenue or an expense, and they're not triggered by an event. So for instance, this first one here, we have a depreciation of equipment. We didn't buy this equipment on 12/31/27. It isn't like this equipment showed up and now we're making a journal entry for depreciation. So it's not triggered by event, and this is one of the reasons why sometimes these adjusting entries don't get made, because there is no event that actually happens. You just have to know that you need to adjust it. So depreciation, this equipment doesn't just depreciate itself. You have to put the adjusting entry into the depreciation. So there is no, event generally that triggers it. You just have to know that these things need to be adjusted. And usually, the places they'll have standard, the new modern systems sometimes will automatically put in most of the adjusting entries, but there's probably always a few that are not automatic. However, a lot of times they would have like checklists to make sure that they do all the adjusting entries they're supposed to do, because again, if you don't do one, it isn't like the system's gonna, say, wait, where's the depreciation expense? It's one of those things that is it can be overlooked. Okay, now depreciation. There's a morbid way to remember it, and I'm going to give it to you. There's probably a better way to do it, but the way you remember it is at the end of its life, this is going to be dead. So DE is the first entry, and AD is the second one. So DE is the debit, and AD is it. So the first one is depreciation expense. It's always this. So we're going to depreciate 10,000. Okay. And AD is accumulated depreciation. Oops. Oh, I know. I do have one more thing to put up here. Adjusting entries never have cash. So as we go through here, there's never going to be a cash involved in any of these adjusting entries. Okay, now accumulated depreciation is kind of a wacky account. I just want to briefly talk about it. I'm sure you guys have done it in your other classes, but if you look down here, this is equipment. This is what we're talking about here. This equipment is the 80,000 is what we paid for it. This is the historical cost. And then we subtract out the accumulated depreciation. And this might be a good time to talk about why we do it this way. It wouldn't be that, it wouldn't be out of line if someone said, well, why don't we just, instead of writing it off to accumulated depreciation, the second account, why don't we just subtract it right out of the equipment? Right? I mean, why don't we just take it right out of here? You know, instead of having this separate account that's going to go against the equipment. You know, this is a contra account, which I'm sure you guys talked about in your accounting classes. But why don't we just take it right out of the equipment? Instead, we leave the, whatever we paid for the equipment, we paid 80,000 for it. That just sits on the books for years. And then we have this other account that goes against it. Why? Why do we do that? I'll show you why we do it. I gotta find space here. I'll put it here. Okay, let's say we have two pieces of equipment. We have a piece of equipment A and a piece of equipment B. Okay, A cost 100,000. B cost 6,000. A has accumulated depreciation of 95,000. I'm gonna clean this up in a second. And so the book value or carry value. Okay, wait a second here. Okay, so we're going to subtract out this A. Subtract out our accumulated depreciation. And so we get the carry values. So the carry values for these two are equal. Right? They're both 5,000. Now, if we were just using the equipment account, they would look exactly equal. Just have the carry amount would be 5,000. Okay, which one of these assets is probably the oldest? A or B? Which one is probably the oldest, probably needs to be replaced soon?
B because it's cheaper.
Well, B is cheaper and replacement is less, but you'll notice that almost all of this 100,000 has been depreciated. So this one's probably older, but you do bring up a good point, and that is, that this one is newer. It's cheaper and it's newer. That the replacement, which would you rather have to replace, A or B? Well, you'd rather replace B if you could, right? Because it's only 6,000. We're replacing A. That's probably a pretty big piece of equipment. That would be 100,000. So you get this additional information that you could have these two different assets, and one of them is probably fairly new. This one's only depreciated 1,000. It's got a bigger percent. Actually, I put the percentage in, I guess, right? Oops. No, this one's 95% gone, and this one is 17%. So, this is the life of a. You don't have to write this down. Just kind of explaining it. But And let's make it this. But the idea being though is that there's this additional information that you get. Whereas if these were both just 5,000, you wouldn't know that this one's going to be replaced fairly soon and it's a big number. You're going to have to fork out a lot of money. Whereas this one is fairly new, it's much less, and you probably don't have to replace it for a while anyways. So those, if you just did it by the equipment account, they would look identical. If we have this accumulated depreciation, it's a little more information for people reading it that they can actually make better judgments with. Okay. Man, this one's long. All right, employees' salaries are paid twice a month on the 22nd for salaries earned from month through the 15th, and the 7th for the salaries earned from the 16th to the end of the month. Salaries earned from December 16th through 3 years. Okay, so we owe them $1,500. What would the journal entry be for that? We don't have any salaries payable. Salaries payable. Yeah. Salaries expense. Oh, we already have salaries expense of 18,900. Okay, so what would be the journal entry for that? Now notice, we are not paying them on December 31st. We're not going to pay them until the 7th of January. Let me write that in here. $2028. I bet you 2028 is when the new version of the book comes out. If I add this up to 27th, okay, that gives us a couple years or whatever, 3 years to write the new one. Okay, so that's gonna be paid on, so there is no cash. The cash will be paid. Right there, cash to be paid on. So we haven't paid any cash yet, and again, these entries do not have cash. So they haven't paid cash yet. What do you think the journal entry is gonna be for that? We haven't paid them, yet we owe them. Give me one of the accounts. Either way.
Account payable.
Yep, we're gonna call it salaries payable, but yeah, it's gonna be a payable. We owe them. Where is it? Those capitalized. All right, so we owe them 1,500. Okay, so this will be. And I'm sorry. It's a salaries payable, it's a liability. It's going to increase with a credit. Is this more confusing? I don't know, maybe it's more confusing to have it together with the. Anyway. So salaries payable. By the way, on a task, if you put in accounts payable, that's fine. It would be some kind of a payable. $1,500. What's gonna go on the other side? So we haven't paid them yet. There's no cash. Okay, now let's go look up here. Adjusting entries always have to have either a revenue or an expense. So what are we probably going to have here?
Salary expense.
We don't have that here. Oh, I know I do have. I'm sorry, it is there. Being strange, okay. And notice we didn't pay them on that date, but we do owe them. And they're not gonna come remind us to make this journal entry because they're not expecting their paycheck until the 7th. If they don't get it on the 7th, then they'll come see us. Okay. On October 1st, Estina borrowed $50,000 from a local bank and signed a note. The note requires interest to be paid annually on September 30th at 12%. The principal is due in 10 years. Okay, so every year they're gonna pay 12%. And the principal is due in 10 years, so they're not gonna pay off the whole 50,000 for another 10 years. Okay, so here's the question: how much do we owe on December 31st? So this date is important. All right, I'm gonna come out here. So so 50,000 times interest of 12% times, how much time have we had this for? How many months do we owe on this?
Wouldn't it just be a full year?
We'll get a full year. We signed this on October 1st. We're at 12/31. If we would have signed it on January 1st, then it would be a whole year. Well, we got this, how many months ago did we actually sign this? No.
I did 2 months ago.
Yeah, see, October, November, December, so we've had it, yeah, for 3 months. Yep. Oh, I don't know what that equals. I'm in Excel, so it shouldn't be too much of a problem to do that. 3,000 times 12, 6,000 a year. Is it 1,500? Don't write that in. Let me go here. So times 3 divided by 12. Hey, that's 1,500. Okay, so we owe them 1,500 of interest as of the end of the year. So we owe them 1,500. What account is that going to be? Well, whenever you owe somebody, what kind of an account is it?
Is it accounts payable?
Yep, account payable. We're probably going to use here, interest payable. But yeah, and if you put up some kind of a payable. So interest payable is liability going up. You don't need to write that down. 1,500. Okay, that's a liability. Now we need to find either a revenue or an expense. No, revenue means money is coming into us, and expense means it's going out to somebody else.
It would fall under interest expense.
Yep. So interest expense, so we owe them 1,500, and that's coming out of us.
Professor,
Yeah.
would it be wrong if you put a note payable because they signed a note on October 1st?
I'll be honest, you know, it probably won't be that big of a deal. But usually the interest part of it is going to be a short-term liability, whereas the notes payable will probably be a long-term because they're not going to pay it for 10 years. So, you know, this would probably be look funny. This will be a short term. So they probably can't classify it as doing. Now, if you classified part of it as short term, that would be fine. You know what I mean? If you had notes payable, part of it long term and 1,500 of it short term, that would be fine. I'll tell you why I don't get too crazy about, especially the short term liabilities, as far as what account, because oftentimes you'll see on financial statements, they combine them. Large companies are almost always combined. They'll say, you know, current payables, and they'll have everything in there. Sometimes they break them up, but a lot of times, so it isn't that I'm being lazy, although I can't do that. It's just because a lot of times you'll see them clumped together anyways. But for this, the interest payable in this case is going to be paid for the short term. Within a year, it's going to be paid the following October 1st, probably 2028. Oh, no, September 30th, 2028. Whereas the note itself won't be paid off until 2020, 2038. 2037, no, 2038. Anyway. Yeah, so this will be electric fund. And again, you know, the short-term liabilities, it is a matter of you generally want to make them as, you know, specific as possible. However, in reality, a lot of times they just get bunched together anyways. On March 1st, the company lent the supplier $20,000 and a note was signed requiring principal interest of 8%. Be paid on February 28th. So principal, so both these are actually short term. This one you could actually put into the note itself. So now this is us lending money to a supplier. Now you might think, well, that's kind of an odd transaction. Why are we lending money to a supplier? Well, it could be due to maybe we have a request that they supply something to us that they normally don't. And possibly they can't go to a bank, or a bank is going to charge them too much. Well, for instance, our bank's charging us 12%, you know, we lent it to them for 8%. So sometimes you can loan money to in this case, a supplier, and part of that is that maybe they need that to supply you with whatever it is you're looking to get. You know, you put in a big order, something like that, they'll say, look, we can't fill that unless you lend us some money to do it. We'll do it, but you know, I'll actually tell you another one we had. Okay, so this is so we're not lending them the money now. It was already lent in March, or March 31st. No, March 1st. It should be over here. Put on here. I don't see it. Oh, here it is. This is it. Notes receivable. So we've already put this on the books, and apparently we paid the cash out on that date. Now, year end, they owe us some money. Question is, for how many months do they owe us money for? So 20,000 times Interest rate is 0.08. How many months do they owe us interest for? Yeah. I'm gonna round it off in here still, but so it's kind of like this. Oops. Yeah, I wonder if it'll copy down the months. If I do this one. Hey, it does. Look at that. Okay, so was this on March 1st? Okay, so on March 1st, the month of the money. So how many? So at March 1st, what, 2 months they going by? So how many months do we owe them? Do they owe us for? They owe us for March and then all the way down here. So they owe us for what, 10 months? And I came up with, I'm gonna round off the nearest dollar. 133.3, I think. Okay, now the difficult part. What is it when someone owes us money? We know that when we owe them, it's a payable. If they owe us, what is it?
Receivable.
Receivable. So probably interest receivable. And that dark. Okay. So probably interest receivable. So they owe us, I'm in the wrong spot. Sorry about that. It's an asset going up. They owe us more money now. And what's gonna go on the other side? It has to be either a revenue or an expense. Now, this is them owing us money. What's it probably gonna be? Here's the choices are over here. It's gonna come from one of these. So here's all our revenues and our expenses. Oh, let's say, yep, interest revenue, yes. Sorry, okay. Yeah, interest revenue. So they owe us money, we're gonna pick that up as a revenue and I'll tell you a weird one I had. When I was at Navistar, we had a part supplier that was a pretty big part supplier. And they were a little bit shaky. I just froze. Imagine my connection's getting funky again. Anyway, so they were a little bit, financially shaky. So they actually had a loan from the bank, but the bank said that we had to, Navistar, the supplier, had to co-sign for the loan. Okay, now, and we did. So we sold them the goods, this was kind of a big order, they were a big supplier. And we actually co-signed this loan. Now the question is, what do you do with it? You have a sale, right? You're selling these things, but you're also on the hook for this loan. And so how do you account for that? And by the way, if you're wondering, well, why did we do that? Why did we co-sign for the loan? Not only to help them get the loan, they're a big customer of ours, but also what you don't want to have happen is this is a big customer, and if the goods are the collateral, the stuff you ship them, the parts you ship them are collateral. What you don't want to have happen is they default on the loan, the bank takes the collateral and sells it. Because banks are terrible at selling stuff. They'll sell it for pennies on the dollar. Notice if you're selling parts, what a bad thing that is, because now you have a bunch of parts out there really cheap. You're not going to collect on it from the customer, the big customer, and you're not going to sell parts to anyone else for a long time because there's a big glut of cheap parts out there. So that was the reason why we co-signed for it, is that not only to help them get the loan, but also if they do default on it, we don't want a flood of our parts out of the market for 20% of the value, and we won't sell anything for the next year. So it was also to kind of protect ourselves. But anyway, that was more. Let's go ahead and take a break. See here. My point being is that this is not that it's not unusual to loan suppliers or customers. Let's say be back at 3:10. Okay. Okay. Paid the insurance company for 1 year insurance policy. The entire 6,000 was debited to prepaid insurance. Okay, so it's right there. And let's make it purple. Okay. So $6,000 for 1 year. The question is, how many months worth have we used so far? Anyone? Let's see, this is April.
9.
I asked a question I don't know the answer to. Hold on. April, yes, yep, 9. I'll do it like this, I guess. Wow. 1 second. Yeah, so the first 3 months we didn't have it, but the other 9 we did, so yeah. 6,000. It's 9, and then divided by 12. 1.1, look. Yeah, I should be able to do that in my head. $4,500. Okay, so excuse me, what's the journal entry going to be? Well, there's prepaid insurance for 6,000. We really don't have prepaid insurance of 6,000. We've used up 4,500 of it, so this account's going to have to decrease. The prepaid insurance is going to decrease with a debit or a credit.
Gonna decrease as a credit.
Yep. Oops. So we used up 4,500 of this set. Do we need a revenue or an expense? Excuse me. And actually, if you know that this one's a credit, you know that this one has to be a debit, right?
Yeah, that which would make it an expense, right?
Yep. Somewhere. Insurance expense. You know, the journal entry system, it really is ingenious. I know it's not easy to use, but you know, once you get used to using it, it makes it, you can still make mistakes, but it makes it much more difficult to make a mistake. Hey, look at this. How come this appeared out of nowhere? Accounts. These don't have that heading. They should have that heading. I don't know. Okay. Supplies. Inventory accounts are common ones that inventory of anything. There's an inventory of supplies. They're a common one to have to adjust. So someone goes out and they say, "Oh, count the supplies that we have," and they come back and they say, "There's 800 of supplies." Okay, so here's our supplies. We have we have 1,500 of supplies, but there's only 800 left. So how much of the supplies did we use?
100.
700. Yeah. I'm gonna do something here. This is how it would look on your. You're doing the calculations for it. So this is say available. So supplies available. Minus your ending inventory. Hey, what? The most supplies we could have used was 1,500. Ending inventory was 8. So supplies used must have been. Okay, so we used up 700 of the supplies. So our supplies account's gonna go down by 700. Oh, where'd it go? So supplies are going down by 700. They're going down with a credit. Excuse me. All right, what do we need on the other side? We need either a revenue or an expense.
Supplies expense.
Yep. Good. So we used up 700 of the supplies. Gone. There's another one that's not really cash that's leaving, it's actually material assets that are leaving. Same idea though, is cash. The cash goes out of the expense. Supplies go out as expense.
So I had a quick question for the one above.
Yeah,
So when we make the journal entry on 12/31, even though it has a whole nother like 3 months, do we have to put that 1,500 somewhere else so the company knows like that they still have the $1,500 prepaid towards the insurance already? Or like how would they know?
that's an excellent question. It'll actually be in the yeah. I'm going to make a T account somewhere here. I'll do it down here. I'll do it here actually. Okay, so this would be, I'm gonna label this as prepaid insurance. Okay, so prepaid insurance. So it's gonna look like this. There was let's see it. Oh, here, prepaid insurance, 6,000. Okay, so there's 6,000 sitting in that account. And by the way, this is exactly why we make these journal entries. So there's 6,000 sitting in that account. Now, when we make this journal entry here, this 4,500 will come down here. It'll be posted into this account. When we get the total, we'll say, okay, 6,000 minus 40, there's 1,500 left. So this is the adjusting entry.
Thank you.
Yeah, it's a, so in the, oh, okay. So this is the adjusting entry that we have, and then it'll automatically show what's left on it. And so, yeah, so if we were to go ahead and post these, I probably should have done that. You probably should do that, but it takes a long time to do that kind of stuff. But they, if we did post all these into the T accounts, that one would show up as being 1,500 left. And the same thing here. This, what would this one be? Well, this one would be like this. Supplies had 1,500 in the account. We used 700. There would be 800 left in, which is what we want to be in there because that's the ending. They went out and counted up, so there's only 800 left. Well, that's what we want. So this would be the adjusting entry. Probably should do that. All right. Let's go to number 7. Company received $2,000 from a customer in December for 1,500 pounds of spaghetti to be delivered in January 2028. Pastina credited deferred sales revenue at the time it was received. Okay, so this is it. So deferred sales revenue. Let's make it turquoise. Now, this is in your other class, they may have called this unearned revenue. Common name for it. So if you remember way back when unearned revenue, this is when someone gives you money ahead of time and you haven't done anything for them yet. And now notice if you don't give them the spaghetti or something, if you don't give them the spaghetti, you got to pay them back the $2,000. So this is an unearned revenue. This is a liability, and it's a liability because we have to do something, or else we owe them this money back. And we haven't given them anything yet, so we haven't earned any of them. Okay, now this is going to be given to them in January. This is a little bit of a tricky one. Have we earned any of this? It says we're going to give it to them in January. So we know we own the 2,000, and we're going to give them the spaghetti in January. We don't need to adjust anything. Okay, need no entry. Yeah, there's no entry. We haven't earned any of it. If we had sent them some of the spaghetti, if we'd have sent them whatever 1,000 pounds of it, we would have earned some of that $2,000. We haven't done anything yet. We're not going to do anything until next month, so no entry. All right, let's go to the last one. Um. On December 1st, 2,000 rent was paid to the owner of the building. The payment represented rent for December and January at $1,000 per month. Okay. The entire amount was debited to prepaid rent. Here it is, prepaid rent. I don't even know what that color is, but anyway. So here's our prepaid rent. So this is an asset. We paid it ahead of time, which we correctly called it an asset. But now we've used, what, 1 month of it? So what's the journal entry going to be?
Would it be rent expense?
Yep. For 1,000. And on the other side, we got to take it out of. Prepaid rate.
Prepaid rent?
Yep. Asset going down, we've now used up a month worth of it. Of it. Okay. I'm gonna do something here though. Look at our solutions manual. I want to make sure I get the. This is problem 2, 3. There it is, no entry. Yay. I mean, not yay, there's no entry, but you know, I think the rest of these are fine. Yep. Okay. Yeah. Any question on that? And you know, these adjusting entries, these are difficult. These are some of the, if you're doing auditing and things like that, these are one of the things you look at a lot because they are they, there's a bigger risk that something, you know, will happen with them. Either that they'll be missed completely because there is no trigger, or that it'll be done incorrectly. I was doing an audit one time and there was a adjusting entry that was put in, and then they did it correctly. It was a correct journal entry, but then they thought maybe it wasn't correct. They took it out. Must have discussed it later and put it back in. They discussed it later and took it back out. Anyway, they put it in and took it out 6 times. Because you know, this was one of the, I don't know, well, what should we do? Well, you know, I'm sure it was one of those kind of things. Anyway, it just, I don't know why, but at year end, they had it in, so actually the books were correct at year end, you know, so if you're doing an audit, you go, okay, you tell them about it, but there's no correction to be made because the actual, it was actually correct at year end. It was a valid adjusting entry. But again, they doubted themselves apparently. They didn't say that in there, but they put it in and took it out 6 times. So they are difficult. They're, you know, something you gotta think about. Okay, closing entries. So after we do our adjusting entries, and here's our adjusted trial balance. This is a made up one, by the way. It's actually made up from our previous one of 2-1. I kind of altered it a little bit. And I'll tell you why in a second. But at the end of the year, so you run this thing, you make your financial statements. We're not going to do that. Yes, we could, but we're not going to do it. But so we make our financial statements, and then we have to zero out all the nominal accounts because we're going to start a new year. You know, if these are the 2027 sales, we got to take those out because we're starting 2028. Same thing with these. The cost of goods sold for 2027, we got to take that out. We're starting 2028. Get the idea. And these nominal accounts, these are really just counters. They just count what's coming in and what's going out. You know, they're adding it up. How much did we pay for dividends? How much did we get in revenues? They're not the revenues themselves, like the cash coming in. People say, well, that's, you know, the cash is, you know, it's actual money coming. Yes, it is. But all the revenue account's doing is counting the cash coming in. The cash is going into a real account. These are called real or permanent accounts. You know, the cash will be there. But we're counting it up because, and why are we counting it up? We're counting it up because that's kind of how we figure out whether we are profitable or not. Right? This is the money coming in. These are the money going out, and we count those to know if we are profitable or not through the income statement, so on. But at the end of the year, we have to cancel those out. They go back to zero. Now, the cash doesn't go away. The cash is still there. But these all have to be reset to zero. Now, everything is closed to retained earnings. I should put that somewhere here. At year end, all nominal accounts are closed to retained earnings. Okay, so all of these are closed to retained earnings, all these nominal accounts. So these are all going to go. What color is it? It's the hardest part about accounting is figuring out the colors. It doesn't look right. Well, I'm leaving it. Okay, so these are all going to be closed out. Okay, so dividends has a debit of 3,000. So if we want to close dividends, what do we need to do to dividends? We need to debit it or credit it. We want it to disappear.
Credit to cancel out.
Yep, so our dividends. $3,000. Hey. A little formatting here. Okay, and everything gets closed out to retained earnings. So retained earnings is always the other side. We'll have this in every single account, retained earnings, every single one here that we're closing out. Okay, revenues. Revenues have a credit balance. So if we want to make revenue zero, sales revenue, I should say, what do we have to do?
Debit at 50,000.
So sales. Oops. And again, it all goes to retainer. Did that a little bit. Okay, oh, this one's not gonna be fun. We gotta close out all of the cost of goods sold and the expenses. Gotta be close. I'm lazy. Okay, so let's see on each one of these. So if these are all debits, to get rid of them, we have to credit them. And I want to know how much these are. Right. 23, 26, 26,500. Yep. Okay, so 26,500. And again, that goes into retained earnings. I should move those up. Oh, wait a minute. Hold on, my indenting isn't. Hey. Why make it a mess out of this one? All right, so let me indent these. Actually, there's no rule on indenting. Well, pretty much most of it's done on the computer anyways, but yeah, there is no rule on indenting, and also there's no rule on, the debits have to come first. I know in the textbook they say debits have to come first. There is no rule. Credits can come first, and actually, what happens often is that as an accountant, you're going to make journal entries throughout the day, and there'll be debits and credits all the way down. And when you submit those to your to the accounting manager, the manager will approve them before they go in the system. You don't just in a larger companies, there's an approval process. You don't just let anyone change the books. Excuse me. So the manager will approve them to put them in. But again, they're all over the place. There'll be maybe 20 separate journal entries with debits and credits, and secondly, the debits are all aligned first or anything. This is kind of a weird book thing. Okay. So let's see how this works out. Retained earnings. So I'm going to post these to the retained earnings account. So 3,000. Hey. $50,000. And 26,500. Okay, so posted all these to the stop. Oops. Okay. Yeah. There, I did it. Okay, so I'm gonna add up both sides here. And we're gonna get a balance for this, so this would be 70,000 minus. So 40,500. With any balance and retained earnings. Okay, so down here we have the post-closing trial balance. So this after we do the closing, now we still need one number. We obviously are not balanced out here. And we need those retained earnings. And that's going to be this number here. Hopefully we'll be in balance. We are. Hey, hey. No good way to show it. I know. Okay. So this is our ending balance and our retained. Oh, I get what they're saying. All right, so I'm going to insert a. You know, this is one thing that I hate about to be an old grumpy man, but this is how I kind of format the shade. Why do they pick light blue as the default colors? You can't see it. I know I can probably do it somewhere in my option whatever, but you know, it's like, why is that the default? It's invisible. Okay, so our retained earnings. So notice these are all reset to zero. These are gone. Now we're going to start a new year. We're going to have new dividend sales and all that good stuff. So this is the closing entries, and these permanent accounts, sometimes called real accounts. Oops. Sometimes these are called real accounts. Sometimes these are down here. Sometimes these are called temporary accounts. Same thing. And we reset those to zero, and we start our new year. And everything's in retained earnings. Everything's in that piggy bank of the owners. All right, so I think, let me make sure. No. Well, it kicked me out completely. Okay, I'm not going to jinx it here. See, we're still recording. All right, I'm not going to mess with it. There's a place to, so both those problems, problem 2-2 and 2-3, along with the closing entries. those are in Blackboard, so you can submit both of those. And then I'll get out the exam, by tomorrow, certainly. Maybe tonight, I'll see if I can get it out, but it's very similar to what we just did. And next week, I'll allow you guys to ask questions and stuff. I won't be able to give you the specific answers, but I will certainly hopefully put you in the right direction, and hopefully it, sometimes doing it on your own, and that it's a good struggle, and you'll learn from it and you never forget it. Any questions? Does anyone want to see anything? Anyone want to see either of those handouts? Okay. All right, and yeah, so I'll send that out. As soon as I get it together, it'll be very similar to what we just did, though. Okay, you guys have enough? Yeah, we'll go call a vet and say, why are the bones sticking out of the dog? All right, I will talk to you guys later.
See you next week. Have a good one.
Thank you. Take care.
See ya.